Gold is often considered a safe haven asset that can hedge against inflation and currency devaluation. However, gold is not a good long-term investment because its price is influenced by many factors that make it volatile and unpredictable in the long run. In this section, we will explore how gold prices are influenced by supply and demand, and why they are subject to frequent fluctuations. The price of gold, like any other commodity, is subject to the laws of supply and demand. When the supply of gold is low, and demand is high, the price will rise. Conversely, when the supply of gold is high, and demand is low, the price will fall. However, unlike most commodities, gold has a very high stock-to-flow ratio, STFR, which means that the existing stock of gold is much larger than the annual production of new gold. This means that most of the gold supply comes from existing inventories rather than new mining output. According to the World Gold Council, the total above-ground stock of gold was estimated at 197,576 tons as of December 2019. This is equivalent to about 80 years of current annual mine production. On the other hand, the annual demand for gold was 4,355.7 tons in 2019, which was mainly driven by four sectors: jewelry, investment, central banks, and technology. These sectors have different motivations and preferences for buying and selling gold, and they respond differently to various economic and geopolitical factors. For example, jewelry demand accounts for about half of the total gold demand, and it is mostly influenced by income growth, cultural factors, and consumer sentiment in major markets like China and India. Investment demand includes physical gold bars and coins, as well as gold-backed exchange-traded funds, ETFs, that allow investors to gain exposure to gold without holding it directly. Investment demand is driven by factors such as interest rates, inflation expectations, currency movements, market uncertainty, and risk appetite. Central banks are another important source of gold demand, as they buy and sell gold to diversify their reserves and manage their balance sheets. Central bank demand is affected by geopolitical tensions, monetary policy decisions, and international relations. Technology demand refers to the use of gold in various industrial applications such as electronics, dentistry, and aerospace. Technology demand is influenced by innovation, substitution, and recycling. As you can see, there are many factors that affect the supply and demand of gold in different ways and at different times. This makes it difficult to predict how gold prices will behave in the long run. Moreover, gold prices are also influenced by speculation and market sentiment, which can create bubbles and crashes that deviate from the underlying fundamentals. For example, in 2011, gold prices reached a record high of over $1,900 per ounce amid fears of a global debt crisis and a weakening US dollar. However, by 2015, gold prices had fallen below $1,100 per ounce as the US economy recovered and the Federal Reserve raised interest rates. Therefore, gold is not a good long-term investment because its price is influenced by supply and demand factors that are volatile and unpredictable in the long run. Gold may provide some short-term benefits as a hedge against inflation or currency devaluation, but it also carries significant risks and opportunity costs. Investors who want to achieve long-term financial goals should look for other assets that offer more stable returns and lower volatility. One of the most common arguments in favor of gold as a long-term investment is that it can protect your wealth from inflation. The idea is that gold can retain its purchasing power over time, while fiat currencies tend to lose value due to rising prices. However, this argument ignores some important facts that make gold a lousy inflation hedge and a poor investment choice. First of all, gold does not generate any income or dividends. Unlike stocks, bonds, real estate or other productive assets, gold does not pay you anything for holding it. In fact, it costs you money to store and insure it. This means that you are missing out on the opportunity to earn income from other investments that could grow your wealth faster and compound over time. Secondly, gold has a negative real return after accounting for inflation and storage costs. Real return is the return you get after subtracting inflation and expenses from your nominal return. For example, if you buy a bond that pays 3% interest and inflation is 2%, your real return is 1%. If you buy gold and it appreciates by 5% in a year, but inflation is 2% and storage costs are 1%, your real return is 2%. However, if gold does not appreciate at all or declines in value, your real return will be negative. According to a study by Credit Suisse, the average annual real return of gold from 1900 to 2019 was minus 1.5%. This means that $100 invested in gold in 1900 would be worth only $14 in 2019 after adjusting for inflation and storage costs. By contrast, the same amount invested in U.S. stocks would be worth $58,685, with an average annual real return of 6.5%. Even U.S. bonds and bills performed better than gold, with average annual real returns of 2% and 0.8%, respectively. The same study also found that gold has been a poor hedge against inflation in the long run. While gold tends to rise in periods of high inflation, such as the 1970s and early 1980s, it also tends to fall in periods of low or negative inflation, such as the 1930s and the 2010s. Moreover, gold has been highly volatile and unpredictable, making it difficult to time the market and capture its short-term gains. Therefore, gold is not a good long-term investment because it does not generate any income or dividends, and it has a negative real return after accounting for inflation and storage costs. It is also not a reliable hedge against inflation or market volatility, as it depends on many factors beyond supply and demand. Instead of buying gold, you would be better off investing in a diversified portfolio of stocks, bonds, and other assets that can provide you with steady income and capital appreciation over time. One of the common myths about gold is that it is a reliable hedge against inflation or currency devaluation. In this section, we will debunk this myth and show why gold is not a good long-term investment for those who want to preserve their purchasing power. First, let's define what a hedge is. A hedge is an investment that protects the value of another asset or portfolio from adverse price movements. A hedge should have a positive correlation with inflation, meaning that it should increase in value as inflation rises. However, gold does not have a consistent or strong correlation with inflation. According to historical data, gold has performed poorly during some of the highest inflationary periods in the U.S., such as the early 1980s and late 1980s. Gold also failed to keep up with inflation during the 2000s, when consumer prices rose by more than 25% but gold prices only increased by 18%. Gold's performance as an inflation hedge depends largely on investor sentiment and expectations, which can change quickly and unpredictably. Gold prices are influenced by many factors besides inflation, such as supply and demand, geopolitical events, interest rates, currency movements, and speculation. These factors can create volatility and uncertainty in the gold market, making it difficult to predict how gold will react to inflation. Another myth about gold is that it is a safe haven against currency devaluation. Some investors believe that gold can protect them from the loss of value of their fiat currencies, especially during times of economic or political turmoil. However, this is not always the case. Gold does not have a fixed exchange rate with any currency. Its value fluctuates according to market forces and can vary significantly across different countries and regions. For example, in 2022, gold prices rose by 25% in U.S. but fell by 10% in euros. This means that gold's purchasing power depends on where you live and what currency you use. Moreover, gold is exposed to political and economic risks that can affect its value and accessibility. For instance, governments can impose taxes, regulations or restrictions on gold ownership, trading or storage. Gold can also be confiscated or nationalized by authorities in times of crisis or war. Gold can also be stolen or lost due to theft, fraud or natural disasters. Therefore, Gold is not a reliable or convenient way to store wealth or hedge against inflation or currency devaluation. It is a speculative and volatile asset that requires careful management and security. It also has high costs associated with buying, selling, storing, and insuring it. In contrast, there are other assets that can provide better protection against inflation and currency devaluation in the long term. These include stocks, real estate investment trusts, REITs, commodities, and Treasury inflation-protected securities, TIPS. These assets have higher returns and lower risks than gold over time. In conclusion, gold is not a good long-term investment for those who want to preserve their purchasing power. It is not a hedge against inflation or currency devaluation, and it is exposed to political and economic risks. There are better alternatives that can offer more stability and growth potential for investors.